Good morning, everyone. Thank you for joining us on a Saturday morning. This is Nikhil from Zerodha, and today we have Gautam Seshadri with us, who will be talking about angel investing in the Indian context. Right. So Gautam has nearly 15 years of experience in investment banking, corporate strategy, entrepreneurship, and venture investing. Right. He started his career in He started his career within the fixed income sales and trading division of UBS Warburg, and during several years with a firm based out of London and Frankfurt, he managed the firm's relationship with some of the largest and most prestigious insurance companies, pension funds, hedge funds, and institutional money managers in Europe. He has been closely associated with the Manipal Group's principal investing and strategic initiatives since 2010 and was later a founding member of RN Capital. At RN Capital, he was principally responsible for the firm's direct investments in early stage tech ventures in India and the US. He led RN's investments in a number of marquee companies in India and the US, including Byju's and Council. Gautam has also served as an interim head of strategy and markets at Sempeutics, a leading global stem cell therapeutics company he recently co-founded. Zen Private Exchange, right? So Zen Private Exchange owns and operates several assets focused on private technology, including a platform for secondary private deals. Gautam is also an angel investor and an advisor to several tech startups, including Blowhorn, India's leading intracity logistic company. He's an early adopter of Bitcoin and an investor in the public blockchain assets class. Gautam is a BSc honors graduate from the London School of Economics and he has an MBA from INSEAD. He is also a CFA charter holder. Right. So over to Gautam now.
Good morning. Today we're going to cover angel investing in the Indian context. I'm Gautam Seshadri. My background was, for the last few years, has been in early stage tech investing. I was part of the founding team at RN Capital. And both in my personal and professional capacity, I've invested in nearly 60 companies, both in Silicon Valley and in India. And I'm going to try and use the next half an hour or so to sort of give you a general sense of angel investing as an asset class and what approaches might work there and what some of the key considerations are that you should think about when getting into this asset class. So let's dive right in. Angel investments are, well, as you might well know, they're pretty much the earliest equity checks that go into startups. And generally, when we say startups, what we mean is tech companies or companies that have technology at the core of what they do. And angels typically, historically, have tended to be people who have been successful tech entrepreneurs themselves. In other words, people who have started, scaled, and sold companies successfully, and other high net worth individuals who have grown to regard angel investing as an asset class in and of itself that they want to get exposure to. Now let's look at the capital formation curve for a startup to understand the different types of capital that a startup requires at different stages. Now, the first stage is also called the friends and family round, also called the fool's round. Typically at this stage, it's still a concept. There isn't really much or any data at all. It's basically a bunch of friends getting together and deciding that they want to do something together. And initially, what typically happens is that you will pool your own capital together and you will try and validate your idea by going into the market. You will perhaps even build a very basic rudimentary prototype of the product. And you will initially bootstrap this out of your own pocket. So, you might have founders putting in 5-10 lakhs each and getting it to a certain point. But eventually, what the amounts required will typically get to a point where you will need to get new capital in, at which point you would go to your friends, you would go to your uncle or your parents and see if they would be willing to back you and your idea. The amounts involved are usually low. The paperwork can range from rudimentary to informal. In other words, you will generally take the money, the paperwork, of course, will happen, but it'll happen a few weeks later. So there is a certain informality with which this kind of a friends and family round gets syndicated and completed. Subsequent to that, of course, things start getting more professional. And that's broadly speaking, that is the stage at which an angel would come in. And this is, you can think of it as the seed stage, early stage. In some cases, it's a pre-series A. They're called different things. But basically, this is the first money into a company that isn't from your uncle or your best friend. And typically, in the Indian context, individual check sizes range from 10 lakhs to 50 lakhs. 10 lakhs is pretty much close to entry level for most seed tickets these days in India. 50 lakhs is more of an outlier at that stage, typically by people who have very strong domain expertise or interest in the area that the startup is working in, and are high net worth individuals with significant capital to invest in the asset class. Usually, angel investments are done in a syndicated way. That means a bunch of individuals come together as a group and co-invest together in startups. You will also get more perspective on why that is important a little bit later, because as you will discover, one of the key components of successful startup investing is the ability to build a large portfolio. N has to be large, which means the ability to syndicate risk and write smaller checks allows you to build a larger portfolio with the same finite investable corpus. And so that's that ability to syndicate the risk is very valuable. Typically, at the angel stage, you will raise in one or two ways. You'll either do a convertible debt round or you will price the round. Convertible debt is a very simple concept to understand. Basically, what it means is, for whatever reason, you decide not to value the company at this point in time, at the time of the angel round. You want to defer that valuation to a later stage, at a point where there is more data, there is more revenue, there is just more traction on the basis of which to value the company by the next investor, who's typically also a more sophisticated investor, such as a VC firm like Sequoia or Axel or Nexus or even Arin, and who are also far more skilled at doing these kinds of private tech valuations. So sometimes what happens is angels will say, look, let's do a convertible round and we'll defer the valuation or the conversion to the next round. And typically that conversion will happen at a discount to the next round. Typically discounts on convertible debt notes range from 15% to 30%. 20 to 25% is standard. Typically, you will also have a cap. A valuation cap is important because sometimes what happens is, you do a convertible debt round today. Subsequently, it can be 12 to 18 months before your investment gets converted into equity and the new round happens. In that period, it is possible that that sector suddenly becomes very hot, or the company becomes a breakout company achieving significant traction and revenues, which means that that next round could happen at a significant up valuation to before. And what that then means is you might just get a 20% discount to a very high valuation in the next round, which obviously doesn't recompense you adequately for the risk that you took at the stage that you came in at. So it makes sense to then have a cap and say, look, my conversion will happen at the lower of those two numbers. It'll happen at the lower of the cap or the value that arises from the 20% discount. To give you an example, if you agree a $10 million cap and a 20% discount, the lower of those two things, then the way it works is if the next round happens at, say, $15 million because the company is very successful and Sequoia or Axel is willing to write a $15 million valuation, then your debt will convert at a 10 million valuation because 10 is lower than 15 million discounted at 20%. And that clearly is better for you because you're getting your shares at a lower price, and that's superior compensation for the risk that you took. The other way to do this is to actually price the round. That could be a situation where Obviously at this stage, valuation is more art than science, but sometimes both founders and investors, angel investors, don't want the uncertainty of not knowing what the valuation is when they come in. And in those situations, it's possible for people to agree on a valuation. I would say in the Indian context, maybe of the deals that I have seen, maybe about two-thirds of them have been priced, but increasingly convertible note style rounds are becoming popular and are increasingly being used on certain kinds of deals. I'm not going to spend too much time here talking about VC firms because there is enough data and knowledge available in the public domain about what they do. But suffice it to say, they collect pools of capital from their own investors and have a fiduciary duty towards those investors to create outsized returns for them. And typically, VC firms have a time horizon of 7 to 10 years and will look to exit after about 5 to 7 years into the journey. Ideally through an IPO, but more typically through M&A or through a sale to a later stage investor. In rare cases, through a promoter buyback, but that usually is not very common in technology deals, which are very binary in nature. They either are very successful or they're not successful at all. Moving on to the next slide. Again, important for you to understand as people very experienced in public market investing, the difference between angel investing and public market investing. The biggest difference is data, or rather the absence of it. In the public markets, you have a tremendous amount of data available to you, pretty much catering for any risk appetite that you have. You can run any strategy that you want, from technical strategies to event-driven strategies to value investing strategies. The problem on the public market side is more telling the noise apart from the signal, because there is so much data that finding the signal in the data is a skill in and of itself. And it's obviously very competitive because the data is available to anyone. So obviously, the search for alpha rests on your ability to garner insights that the market doesn't from the same data. Angel investing is very different. It's far more social than public investing. Public investing, really, you just need your Bloomberg screens and a Reuters screen, perhaps, and some public data sources, and you're good to go. Angel investing is about communicating with people. It's about endless cups of coffee with founders, with co-investors. It's in a very real sense about building relationships with a lot of people in the ecosystem and then connecting the dots between those people and those conversations in a way that builds value for everybody and ultimately for you. So both at a psychological, emotional, and almost spiritual level, it's a completely different game. And one of the reasons why your network is so important, and it has to be a social game, is you can't know everything. And if you want to build a large portfolio of reasonably priced, promising early stage startups, then it's very important that you have a network of trusted guys around you who also do what you do, with whom you can both syndicate the deals as well as share diligence insights, share ideas. It's very important, especially because it is a long-term game. Obviously, another important dimension to understand with angel investing is it's really just about having comfort with the founders. So you're almost literally and metaphorically backing founders, which means if 50% of your diligence isn't spent on getting founder referrals and founder references and getting comfortable with who they are and what they have been and what they could possibly be, then you're probably not focusing on the right things. So in the Indian context, the order in which I would put the priority set that you should have is founders, market, followed by technology. Moving on to the next slide. I just wanted to sort of unpack for you the ecosystem as it exists today. Now, for an angel investor, there are multiple angel networks that are clustered around cities that you can join. There are Chennai Angels, Mumbai Angels, Hyderabad Angels, and many of them are pretty active today. There's the Calcutta Angels as well. There are some like the Mumbai Angels that are more like a pan-national angel network in that they have chapters in many cities around the country and are expanding to many more. That is also true of the Indian Angel Network, the IAN. And these can be very useful um, early sort of launch pads for you as an angel investor because it gives you instant access to a large pool of potential co-investors. Plus, these guys actively find deals and syndicate them in their network. I think Mumbai Angels, the annual membership that you have fee is about 50,000 rupees, which might well be worth to spend early on as you build both expertise and relationships in this asset class. It can give you a head start. And a lot of these angel groups, what they do well also is they will do a lot of diligence on these deals. So they'll give you a lot of data uh, that you can then mull over and decide what works for you and what doesn't. And that's very helpful again early on where, you know, you have a lot of learning, you have a huge learning curve early on as an angel investor. You're still learning the ropes, you're learning the do's and don'ts of engaging with founders and engaging with the ecosystem. And this is a good way to sort of slip into something where a framework is already in place and can help guide and steer your sort of engagement with the asset class. Of course, being in these networks, building comfort level doesn't preclude you from doing deals outside of those networks also, but it might be a sensible starting point for some of you who are new to the asset class and who want to get a general sense of how angel investing works. I'm not going to spend too much time talking about the opportunity to angel investing because I think it's well understood. Obviously, in the hyper-deflationary world that we live in today globally, right, where compared to 10, 15 years ago, it costs you 1/10 of what it did before to start a web or mobile application. It takes you 1/10 the time and it takes you 1/100th the money to do that today compared to 15 years ago, which means in a very real sense, what you have is an asset class where there are far more startups today than there ever have been. And the reason is obvious because it's never been so cheap to start one. It's also never been so hard to build a successful one. That's the other side of the coin. So I think we're going to see tremendous action in India because it's demographics, it's the fact that technology is a huge equalizer and a democratizer of access to opportunity and an absolutely a powerful force for unlocking human potential that's all around us. But having said that, remember that we're in a world where there's going to be more startups than ever before. Fewer of them are going to succeed than ever before, and the ones that succeed are going to succeed on a more absurd level than ever before. So, you know, it's almost like Piketty's inequality pyramid in that the winners are going to be more unequal than ever before. And there's going to be a huge number of losers. So your angel portfolio, which I'll get to in a jiffy, has to sort of like build and provide for that vision of the future. In fact, it's the vision of our present. And it doesn't take much imagination to realize that that's how it is going to evolve going forward as well. Okay, now we get to the important parts. Now let's talk about what a good angel portfolio looks like, which I would imagine is what some of you guys are looking for some perspective on. And you know, some of these thoughts are based on my own experience as an angel investor and as an early stage investor through RN Capital. Now, you need to have the first and most important thing that you need to provide for as an angel investor is you need to have the ability to build a large portfolio. This is all about making the law of large numbers work for you. Most deals will fail. They'll either not return any capital or they'll return a fraction of what you invested. The winners have to make up for it. And that means especially if you buy into the vision I painted 2 minutes ago, which is that you're going to have fewer winners, but they're going to capture a disproportionate amount of value compared to before, then what that means is you clearly want to have a portfolio that's large enough to give you a very high or decent probability of having the next Ola or Flipkart or Uber in it, because that is what's going to make up for all the losses. So as we like to, a slightly nerdy sentence that's quite popular in the VC industry is, it's not about the frequency of your losses, it's about the magnitude of your wins. So discipline is very important also. That's related to the law of large numbers, in the sense that at that early stage that you're investing as an angel, it's impossible to have more conviction about one idea than another. In other words, if you think you can spot winners, you're probably kidding yourself. At that stage, the winners don't look like winners. Uber, when they were raising an angel round, didn't look like the Uber of today. Neither did Flipkart. My point is this: have the discipline to stick to your thesis. Always, where possible, equal weight your investments. In other words, just because a guy has come to meet you and he seems super impressive, and you're doing two deals and one guy seems more impressive, more eloquent, more paper pedigreed than the other, and you've decided to do both deals because the other deal is also a good deal for other reasons, please resist the temptation to do 20 lakhs in one and 10 in the other. Have the humility to recognize that you can't spot the winners, equal weight, because you don't know where the winners are going to come from. Over time, one of the key learnings for you has to be directed towards building intuitions around not who the winners are going to be, but about spotting losers. Because in my experience, your intuition can be honed to spot founding teams and companies that don't have what it takes to be large companies, but it's impossible to do the other thing, which is to spot the winners. So basically build a large portfolio over time, where over time what you're doing is you're sort of like building this almost like this portfolio of unexercised out of the money call options, and you're sort of culling and excluding or culling names that where you have the intuition from the outset that they are not going to get there. So that's what the game is about. The next most important point is pro rata rights. Now, pro rata is very important in venture because remember, if what I'm saying is true and the winners are going to take the disproportionate value, then what you want to be doing in the next round, as some of your initial portfolio starts coming on for follow-on rounds and the winners and the breakouts start emerging, you want the right to protect your percentage in the company is very valuable. So you want to be exercising some portion of that pro rata right. And one important dimension of investing through angel networks like IAN or Mumbai Angels is you're coming in as part of a syndicate, so that's part of the deal. It's sort of like pre-negotiated with founders, so you don't need to ask for that additionally. You get automatic pro rata rights. That's very valuable. In my personal angel strategy, I'm about a 65-35. That means 65% of my angel portfolio goes straight in at this angel stage itself, and 35% is reserved for follow-on rounds, where I double down and triple down on winners in my portfolio. And I find that serves me pretty well. Last, slightly trivial point, diversification. I think you guys are intimately familiar with why that's important, so I'm not going to belabor it. I would add, however, that since some of you will have operating backgrounds and will have deep knowledge about certain industries and sectors, that could be a good starting point for your career as an angel investor, because you want to start with stuff that you understand at a good level and where you can add value to the founders and build reputation, importantly, through the ability to add value that you can then leverage as you build out your portfolio in other sectors, therefore achieving diversification. So you might want to start with the familiar and then build up the courage, the conviction, and the knowledge to then segue into other sectors less familiar. And that's also a route that can be facilitated for you by having that trusted network of co-investors and angel groups where people have expertise in other areas that they can get you into. Next, this is supposed to be a little bit of a summary slide, containing both, slightly intuitive things about things that you have to do and be to be successful, in my opinion, and hopefully a couple of things that are slightly less intuitive. First point, you have to be comfortable with saying no a lot. And this is a big change from being a public investor. The public investor, the companies that you don't invest in don't know that you ever considered them. So there isn't really any emotional or psychological cost to you to making that decision because it's an invisible decision. Here, you're looking that guy in the eye and you're telling him that you don't believe in his idea or in him. That's a hard thing to do. I mean, it's a hard thing to do. Unless you're a sociopath, for most normal human beings, it is very hard to say no. It's also very hard to keep saying no. But that's something you have to do as an angel. You have to say no a lot. And one way that I have found that works for me, that helps me to do that, is if you have to say no, say it quickly, say it clearly. Don't waste the founder's time because he is punting his whole career and life on that idea. The least you can do, if you're not going to be part of that journey, is to get out of the way and not leave him in hope that you are going to support him. So the trick here is say yes very quickly the moment you have conviction in an idea, and then follow through on it and invest money early. The only thing that you have to be even quicker at than saying yes is saying no. Very important. And in my experience, tells founders a lot about the people that they're dealing with on the other side. So saying no quickly, being able to reason it, and learning to be comfortable with saying it a lot is critical to your success as an angel investor. Secondly, important, remember you need to build a large illiquid portfolio over time to be successful at this. That means you need to have a capital base. Now, generally speaking, angel rounds, we're looking at about a 10 lakh outlay per company. If you come in as part of the Mumbai Angels or the Indian Angel Network, I believe they'll allow checks as small as 5. So my advice to you is, if you don't have the stamina to do at least 3 to 5 deals a year for the next 5 to 10 years, you might want to not do this in a more serious way. Because if you want to do this seriously, then you need to have that kind of holding power and that kind of firepower to invest. Otherwise, you can't make this asset class work for you. Again, next point, important, build a trusted network of co-investors, people who have complementary skill sets, who have different areas of domain knowledge, be it HR, recruiting, technology, other industries. Build that network over time and learn to share deals with them, learn to collaborate with them. Remember, you're in the tech industry. And the tech industry is, it's like the old joke about open source versus closed loop. In this industry, collaboration is key. So yes, there are situations where you keep certain things to yourself, but in general, you benefit from sharing knowledge and in soliciting it from others. You need to have a long-term horizon, at least 10 years. If you don't, this asset class doesn't work for you, because I'll give you an example. Nawal Ravikant, who's the founder of AngelList, is probably one of the best angel investors in the world. He started a fund in 2007 called HitForge. And HitForge today is about 15 to 20 times larger than the corpus. In other words, he's 15 to 20x up on his investment. So, which is great, but what's important to understand is he's only returned a fraction of that to his investors, which means a large portion of the value in that fund is still embedded in it, and hasn't been distributed yet, because these companies take a long time to sort of come to fruition. And some of these companies in that portfolio are names like Uber. Obviously, an Uber IPO is expected in the next 12 to 24 months, at post which there will be these distributions. But remember, this is an asset class where you can be rich on paper for a very long time before you see any money. So be comfortable with that. Next point, and this is one very close to me, to my heart, be graceful. Most startups won't make it. They will fail. Don't make it hard for the founders. Don't be unnecessarily difficult. They've taken the risk. They've pitted their lives against the market. They've lost this game. Don't make it hard for them. Be graceful when it happens. See how you can help and move on. And remember, in a long-term game, reputation matters a lot. A reputation for grace when things go badly is a very, very powerful reason for founders to work with you, especially the best founders who will check on angel investors the way you will check on them. Remember that. Next point, understand that you don't run the business. They do. That's why you're backing them. Related point is, if you have an operating background and somebody is telling you a story about what he's going to do with his product, don't extrapolate that to what you would do with that market and with that product. Listen to what he is saying, because remember, you're not going to run that company. He is. And that's a mistake that a lot of angels with operating backgrounds make. They think too much in terms of what they would do in the founder's place. Remember, you're not in the founder's place. You're backing the founder and you're his partner. Be there for them when they need you. How do you do that? You don't do that by being overbearing and inviting yourself to situations. You do that best, in my experience, by setting expectations and frameworks early in a relationship, where you tell them, look, this is what I can bring. This is the time that I can give you. Use me along those dimensions in this way. And that usually is very helpful for founders, because it helps them understand where you would fit in the picture if they ever needed something done or an introduction made, or your perspective on something. Again, important. Over time, it helps to build an area of expertise, because that tends to lead to repeat referrals to you of companies working in that space. It helps, of course, if you actually have an area of expertise like edtech or fintech, and you want to take that and build off it over time to achieve diversification. But it's important to stay informed about other things. There's a great excuse to keep learning, so make sure you do that. Ask a lot of questions, because as an angel investor, one of the great prerogatives that you have is you can ask any question. They want your capital. They better sit and answer it. So make sure you ask the questions, because the only thing for me that's at the same level as making money off my angel investments is to actually learn a lot. And you're going to be working with and talking to a lot of very smart young people. So make sure you get that benefit from it. Lastly, have fun. Don't be serious about it. You're going to meet a lot of people. It's a social game. Have fun, enjoy the journey. And remember, in the end, in the ultimate analysis, being successful as an angel is not that dissimilar to being successful as a public investor. It's about being contrarian, and it's about being right. And while there is no really good way to teach either, following your conviction and over time building intuition about people and ideas is a good place to start. It's perhaps the only place to start. So make sure you're doing that. Now, moving on to the last slide that I have for you. This is more of a generic slide where I want to talk a little bit about the path ahead. I think this asset class is going to stay very noisy even going forward. It's covered a lot now in the tech press, in the media. It's almost become this fashionable salon game that people want to be in. It's, in my opinion, it's, if you want reputation in the papers, if you want the papers to write about you, angel investing is pretty much the second best thing you can do apart from being a founder that gets you there. So expect that to continue. I think the government is going to bring in some tax benefits, such as tax loss harvesting for angel investing. I have mixed feelings about that personally, because I think angel investing is hard and should be continued to be seen as hard in order to attract the right kind of people who have, who are coming in for the right reasons, who understand the asset class at the level, as I articulated before, at the right level. And anything that softens the blow might end up sending the wrong signals to prospective angels. But having said that, I guess on balance, a government that's interested in enabling more capital into startups is thinking about it the right way rather than not. So on balance, I'm constructive about it, though I have some concerns, as I said. And these days, startups are looking not just for capital, they're also looking for expertise. So if you have a relevant domain, Make sure that you practice articulating that, because the best startups are competitive to get into. So you need to compete hard to get into those deals. So you need to be able to articulate what value you can add beyond capital, right? So make sure you practice that. Remember, you're pitching yourself just as much as a startup is. So make sure that your own pitch comes out right. Lastly, a lot of people got into this asset class on a wave of 2014 and 15, and I would expect to see a bit of a shakeout in 17 and 18 as losses start to accumulate in the ecosystem, as you see trickle down effects of our large unicorns tightening their belts and in general reworking their business models. That's happening right now. And I think that's going to lead to some pain for a lot of people who came in without understanding what angel investing is and how it is a long-term game where you need to have a large portfolio and a significant threshold for pain and illiquidity, which is sad, but in the long term may benefit the asset class if a lot of the not so clued in capital goes out and more knowledgeable longer term capital flows in. So I would hope to see that in and out flow happening hopefully over the next 24 months or so. Lastly, I'll leave you with this thought, which is a summary thought. Angel investing, it's a long-term game, it's a social game, and it rewards hard work, it rewards application, it rewards diligence, patience, and above all else, it rewards reputation.